I went here as a student, and I have the great fortune of being a professor here. I haven't met a lot of you, but I will. My name's Todd, and I'm delighted you're here. This is Chicago Best Ideas talk. These talks started as a way of introducing new students to Chicago to some of Chicago's best ideas. We've run out of them, and so they've changed into something else, which I'll tell you in a second. But just to tie it back to the tradition, I believe in tradition. There was a piece by a guy named Harry Kelvin Jr. and a guy named Maurice Rosenfeld. They wrote a paper in 1941 about class actions.
Turn your mic on.
Turn it on. Class actions. And they use as their example securities regulation and the necessity of having class actions to enforce securities fraud and how private lawyers could be better than the government. And that will be a theme that I come back to. They got it wrong. The next feature of the modern Chicago's Best Ideas is expose students to the latest Chicago ideas. Not the best. That's yet to be determined. And you guys can go to the end, but probably not true here. And that's the basis of my talk. Joint work with a guy named Kevin Haberly, who teaches at South Carolina. And then also to act as kind of a trailer for other content you can get at the law school. And so this is a trailer for securities regulation for those of you who haven't taken it, which is going to be with me in the winter, or 2 L's 3. You should take that course, it's great fun. Okay. The punchline from today is the entire securities regulation apparatus we have should be dismantled and replaced with something completely different. The regulation is not just not worth the cost, it's unbelievably perverse. If we replace this central problem of securities regulation with a market system, we get all these benefits. Better disclosure from corporations, better allocation of the costs, better policing of fraud, and better results for average Americans. At the end of the day, I hope I can kind of convince you that even though this argument is going to sound unbelievably Chicago, I'm at Chicago, I went here, I'm wearing a University of Chicago tie, I have a Freebird, which is making Dean Nagorski have agita, up on my slide, even though this is so Chicago. Markets, not regulation. Liz Warren, God bless her heart, should support my ideas. That seems like a win-win. If I can agree and Liz Warren agree, this should be policy. Okay, I'll try to The central problem of securities regulation is informational asymmetries. Companies that are raising money do so in the primary market. Issuers of securities, that's companies, sell stocks and bonds to investors. And when they do that, the companies have a lot more information about the company than the people buying it. This is the document that Facebook filed when it registered to sell securities. It's 500 pages long. Thousands of man-hours went into producing this document. The lead lawyer was a guy named Ted Elliott, who was a graduate of this law school and took, I don't know, a lot of money out of Facebook for doing this work. But this isn't the stock market we normally think of. This initial public offering is a very tiny part of it. Another part of it, and what we think of as most of the stock market today, is a secondary market, and that's the New York Stock Exchange, investors trading with other investors. And in those trades, too, there can be informational asymmetries. After all, some investors may have better information about a company's prospects than other investors. And securities regulation is primarily designed to reduce the information between issuers and investors, and between investors in the secondary market. It is premised on a coerced disclosure regime. Force companies to disclose information to their investors and force them to disclose information in the secondary market so that the trades among investors happen on relative information parity. This regulatory apparatus is 8 decades old and is largely based on completely unrealistic assumptions about the way modern securities markets work. Okay, so what are the current solutions to informational asymmetries in securities? The first one is Regulation SK. Regulation SK tells companies exactly what must be in here. It is a government recipe. It is a command and control approach to regulating information disclosure. So normally when we want to ask people what information they want, or to give them the information, well, we can ask them and say, well, what information are you interested in? The government in securities doesn't ask investors. It tries to imagine what information they would like and prescribes a recipe down to every single item that must be in that document that I just showed you. It's a guess as to what investors want, or maybe what they should want. Another component of this information market to remedy information disclosures is a very robust anti-fraud regime. After all, if I'm an investor, can I trust what Facebook discloses in this voluminous document? If they're not held accountable for the lies that they would tell in here, then that will cause me as a potential investor to pay less for the shares than I would if they could credibly commit to me they weren't lying. Imagine there's two companies, a good company and a bad company. And the good company cannot distinguish itself from the bad company, the one that's going to lie to you. And I don't know as an investor whether I'm investing in a good company or bad company because they can't distinguish themselves. And that would be the case in the absence of a strong anti-fraud regime. Knowing that, I would ascribe some probability of being defrauded to even the good company. That would mean I would pay less for the shares, and that would raise that company's cost of capital, which is bad for everybody, especially the good company. In other words, the good company would be cross-subsidizing the bad company. An anti-fraud regime, if you opt into it, says everything in here is true. And the fraudsters are going to avoid that market because they know they'll help you out the counter. Okay, so the Calvin idea for securities regulation is this anti-fraud regime is largely going to be policed by private lawyers. Plaintiffs' lawyers using class actions are going to be policing fraud securities markets. We have insider trading law. Insider trading law prevents people who have inside information or information they got from insiders from trading. It's about forcing information disclosure to remedy information asymmetries. And then finally we have Regulation FD. Regulation FD stands for Regulation Fair Disclosure. Regulation FD requires companies to transmit corporate information at exactly the same time to all investors. The object, not surprisingly, is fairness. After all, if I'm a company and I have information that's valuable to the market and I disclose it to him, before I disclose it to him, and these two trade, they will trade on different information. And that's not fair. So I have to disclose it simultaneously to the entire market. I can do so via Twitter, Facebook, news dissemination services, so I'm not limited in how I can do that, but it has to be simultaneous disclosure. This is a vast, vast regulatory apparatus. And no one has any idea how much it costs. I have looked and searched in vain. I've asked every think tank and interest group if they have any ideas, and no one has tried to put an estimate on this. So we have this giant regulatory apparatus which is designed to get information out of companies and into the hands of investors. Thousands of suits of all these different kinds. Lawyers at every firm, every business that issues securities has hundreds of employees who deal with nothing but these 4 bullet points. So we have a huge cost, and presumably there's some benefit, but this is Chicago, so we don't take anything the government does and just say, oh, well, it must be that the benefits outweigh the cost. We should put this to scrutiny. We should ask ourselves, what are the benefits of this system, and are they outweighed by the cost, or do they dwarf the cost? Okay. Could we do it in a better way? Okay, one of the problems with this current system. So, first, the disclosure is highly inefficient. If the goal of the disclosure is to give investors information they need to make investment decisions, then why in the world are we prescribing the kinds of things that investors get by having bureaucrats and politicians guess as to what they want? For instance, the Congress and the SEC have recently passed 2 new disclosure requirements for firms. One is that firms have to calculate the ratio of pay of the CEO to the average employee. I can stand here today and tell you with absolute certainty, no investor cares about this number. I should note, before I sound like I'm a shill for corporate CEO pay, although I am, I should note, we Americans might really care. We all might want to know the pay of CEOs relative to average workers. Just like I want to know how much Angelina Jolie is making for her latest movie relative to the person who does her hair. That may be a relevant, politically salient thing, but it has nothing to do with investors qua investors. Conflict minerals. Companies now have to certify in their disclosures that all of their products are free of so-called blood diamonds or conflict minerals. Again, this may be the most important issue facing America today. It's not. But even if it was, this has nothing to do with investors. Investors don't care if blood diamonds are part of your supply chain. These are political issues that have corrupted the securities disclosure regime, and there are hundreds of them in this document. If we as a society want these things to be disclosed, we should have all companies disclose them instead of muddling them up with in the securities world. The form of disclosures. The font, pagination, type, has not changed on this document since I was a law student. And we didn't have the internet when I was a law student. That means this is like stone tablets to the high-speed traders that prowl the canyons of Wall and Broad Street in New York. They want information, modern investors want information in machine-readable forms that they can just put into their algorithms. They don't want this. And yet, this is what they get. This is what the bureaucrats in Washington think. Courier 12 point. That's exactly what people are demanding these days. Timing of disclosures. The timing of disclosures, because companies are forced to disclose, but they're only forced to disclose at particular periods, and only when the bureaucrats tell them they have to disclose, companies are very gun-shy about additional disclosures. The minimum standards set by the SEC become not just, they were intended to be floors of disclosure, but they quickly become ceilings. Firms have legal risk from disclosure. They can be sued under the securities laws. If there's anything in this document that is a fraud, a misstatement or omission, they can be sued. So disclosure has cost. It has no benefits. How does the company benefit by disclosing new information to the market? After all, in the secondary market, investor trading with investors, the company's not profiting from those trades. So they have very little upside and disclosure risk, which means we're going to get less disclosure. We're not going to see lots of disclosure. Potentially not as much as the optimal. The cost allocation. Whatever the size and cost of the securities regulation regime is, I did a McKinsey style, pull it out of my back of the envelope kind of estimate, and I think it's probably a couple $100 billion per year. Who pays that? Well, it's a tax that is paid by all investors. Every American who is an investor in a U.S. corporation pays, which means every American pays, because almost everybody works for a corporation. They produce most of our GDP. So the disclosure regime is something that's paid for by coal miners and pensioners and teachers and firefighters, etc. But who benefits from disclosure? Who benefits from disclosure? Well, everybody benefits from disclosure insofar as disclosure helps ensure that capital is allocated efficiently and corporate governance is of a relatively high quality. Everybody in society benefits from that. But one group of investors benefits in something else in addition to that. And those are the people who are the traders who make trades based on changes in corporate information. That's not you and me who invest in 401ks. That's not average Americans whose optimal strategy is to buy stocks and hold them until they retire. The people who benefit in addition to capital allocation and corporate governance are high-speed traders, hedge funds, and other people who make as their living buying and selling shares in the short run based on changes in information. Those people are the people who profit from coerced corporate disclosure, but they pay no more than the average shareholder does on a proportional basis. This is the part that Liz Warren should really like. If we could figure out a way to make the information traders pay as opposed to the average traders, that would be a win. It would be better than a tax on Wall Street trades, which is something that several Democratic politicians have proposed. Disclosure is unchecked. The Regulation SK had, in 1990, 7,500 words. Last year, 130,000. 15,000 words were added to the Code of Federal Regulations and Regulation SK in the last year alone. So this system of more disclosure must be a good thing, politicians and political apparatchiks at the SEC adding more and more disclosure items into these documents has a huge cost on corporations. Corporations have to collect this information. They have to certify that it's true, otherwise they face liability. These are huge costs. There's other costs. The litigation risks that come with making even innocent mistakes. There's even more costs. The more disclosure we give people, the less people pay attention to the disclosure that already exists. Disclosure is not free, and it's become, unfortunately, a dumping ground for the political whims of our rulers. Investor fairness. This disclosure regime is premised on being fair for investors. Well, why do we give people information? Think about going to the store and buying a granola bar. When I was a kid, back in those halcyon days, you'd go to the store and you'd buy some cheese puffs, and you had no idea the poisons you were putting in your body. You didn't know whether it had gluten or GMOs or how many grams of fiber were in it. I didn't even know what fiber was when I was your age. Well, thankfully, our benighted rulers have now told us how many grams of fiber are in our granola bars. We can all sleep at night. My guess is that nobody, the average person never looks at a food label. They pay for it, just like all shareholders pay. That food label it's not free, and so everybody pays for it. And, you know, probably the Lincoln Park set looks at food labels, but of course it's being paid for by coal miners in West Virginia. That's its own kind of problem. But at least that kind of forced disclosure that's paid for by everybody could be justified on the grounds that maybe it causes people to change their behavior. I never would have looked at how many calories were in the double baconator. But now that you forced me, I now will update my preferences. Okay, that's a plausible story. I don't believe it for a second in the food labeling context, but okay, maybe. It is not only not true in securities, it's perverse. We don't want people trading on information. There is a theory that goes back to a University of Chicago professor named Harry Markowitz called modern portfolio theory, which tells people, this is 1953, tells people the optimal strategy for investors is to buy and hold for the long term. Buy a portfolio of the entire economy, some index that represents America writ large, and over a 30-year period, you will get a 6.5% return on your money. That's what everybody should be doing. If you're an investor and you're not doing that, you're wrong. And if you think that there are people out there who can pick stocks and systematically beat the market, you're wrong. You are as likely to go to Vegas and win. The returns are, there have been some studies on this, almost identical. You go to Vegas, you get back 97 cents on every dollar you spend. You go to Charles Schwab, you get back about 97 cents per dollar that you spent. So we've known this since the 1950s. The optimal strategy for average Americans: ignore all corporate news. Dollar cost average. Invest a certain amount every month that you can afford, and forget about it until you go to retire. What is forcing average Americans to get information disclosure about companies do? It, first of all, gives them information they don't need. Information we don't want them to have, because we know it's socially suboptimal for them to be trading in individual stocks. It's costly for them, and especially when it's pitched in terms of fairness, it may encourage them to act in ways that we know are going to harm them. It would be better to put a giant sign up on Wall Street that says, unfair in the short run, really good for you in the long run. That would align people's incentives with what we know mathematically is in their best interest. In terms of deterrence of fraud, the system that Calvin and Rosenfeld imagined has been an abject failure. It is true that private lawyers have stronger incentives to bring cases than the government might. They don't face budgetary constraints. Private entities attract better talent than the government does. But the problem is the economics of the litigation system encourages nuisance suits that basically are used to extort payments from companies that go into the pockets of lawyers. There have been 4,000 lawsuits since 1995. Securities fraud lawsuits. Companies have paid $90 billion to settle these claims, and almost none of them have anything to do with corporate fraud. There is zero evidence that any of these suits actually deter corporate fraud. In addition, companies have very weak incentives to police insider trading. Insofar as insider trading is a bad thing, corporate executives trading on information, the company cannot profit from any information that corporate executives use to trade. The company has to give it away for free. It has to give it away for free, and it has to give it away simultaneously to all investors. So if the CEO has inside information and she's trading on it, she's not harming the corporation in any way. Maybe indirectly, it generates some lawsuit or something, but not really harming her. But imagine if companies could sell corporate information. Instead of giving it away for free, what if they could sell valuable corporate information? Well then, if the CEO was taking that corporate information and selling it for, using it for her own purposes, that would harm the corporation because presumably the company would be able to charge less for the information it sells in the market as a result. This is a preview of where I'm going to go. Okay, so my view of the current system is it doesn't work. It's costly. It has very bad incentives about getting the investors who really want and use information, the information they want, in the form they want it, and when they want it. It deceives the most vulnerable investors into believing they can beat the market. Doesn't adequately police and deter fraud. Okay, so to set up my proposal, I will start with some assumptions. I'm a welfarist, which means my objective function here is not to maximize shareholder value or CEO power or anything other than what I think is social value. So I'm coming at this from a social welfare lens. Corporate information is corporate property. The information contained in this document was generated by Facebook. It belongs to Facebook. There's nothing public necessarily about this information. And corporations, our starting principle should be that people who produce information can use that information. The Supreme Court, the noted right-wing Justice RBG, the notorious RBG, said as much in a case called O'Hagan. Corporate information is corporate property for them to use as they see fit. This may be heretical at Yale. Are they still even having classes at Yale? It seems like maybe they've stopped thinking there. But insofar as they are having classes, and insofar as they did learn anything at Yale, these arrows would be reversed. Of course, government bureaucrats are better than markets at deciding things like what should be in the content of disclosures. But here at Chicago, our starting position is markets are better than command and control. Does that mean markets are going to provide perfect solutions at all times? Of course not. Of course not. Even the 1Ls in here know, and I've seen many examples of places where there are real market failures. Pollution just being a classic example. But there are many of them. But our starting position should be that markets are going to do better than similarly situated command and control. The SEC's fairness rule, Regulation FD, unsupported by any evidence that it actually improves fairness. In fact, by duping people into believing markets are fair, it probably is unfair. Maybe that's what the SEC was up to, but we'll come back to that in a minute. Information technology, computers. I now have one on my wrist. They enable trading in ways that would have baffled people in the 1990s. And information technology has made securities markets today an absolutely pros-only game. 22 seconds is the average time that a stock in the United States is held by an owner. 10 years ago, this number was 7 years. 22 seconds is the average time every stock is held. That shows you the velocity of exchange and how many trades are happening on Wall Street and how much corporate ownership is diffused through the society. 15 milliseconds is the amount of time it takes the market to incorporate new information. My evidence for that is the University of Michigan collected consumer sentiment information. They asked people in a survey about their views about the economy. Are you going to be buying a refrigerator and a PlayStation this year? And they had a score. They came up with a single number like consumer sentiment is 30. Whatever that is. Yeah? That information is hugely valuable because it's an estimate of future economic growth. So the materiality, the value of this was well established, and traders wanted this information. University of Michigan sold it to a company called Thomson Reuters. They make a lot of your textbooks. And Thomson Reuters released this information at 9 o'clock, every month. Monday, second Monday of every month, 9 a.m. But Thomson Reuters realized they had something valuable. Market-moving information. And market-moving information they did not get from inside any company. Therefore, not insider trading. What would you do if someone, this is like the end of Cat in the Hat, what would you do if your brother, what would you do if you found yourself in possession of unbelievably valuable market-moving information that was not illegal for you to sell? You'd sell it, which is what Thomson Reuters did. They said, oh, we're going to be telling those fools in the public that we're releasing this at 9 a.m., but we'll sell it to you 2 seconds early for a subscription price of $6,000 a month. Plus you get this set of steak knives. Lots of hedge funds paid $6,000 a month to get 2 seconds early access of this information. And researchers looked at how quickly the stock price of S&P E-mini futures traded here in Chicago changed in this 2 second period. And the price fully changed from its level that it was at to the level it should be at, given the results of the consumer survey, in 15 milliseconds. Including the time it took for the information to get from the Thomson Reuters building in Manhattan by the speed of light down to Wall Street to the computer of this high-speed trading firm who took that number and processed the change in price and executed the trades, and then to the exchange and in there and through that all happened in 15 milliseconds. Which means if you're Billy Bob and you're sitting in Des Moines at your computer terminal and you're watching Squawk Box and you don't even want to blink and you're just watching, waiting for the consumer sentiment information to happen, and you press enter as soon as possible, pre-programmed, it would take you might as well be trading in 2,000 years. Over your DSL line, to the switching station, up to the satellite, down to your broker, your Edward R. Jones broker in St. Louis. I mean, no. No. You shouldn't be doing it. And even if you should be doing it, you are hopelessly outgunned by people who have made massive investments in doing this at unbelievably high speeds. Okay, the last assumption is this one, which is we are okay with staggered starts. We're okay with staggered starts. If you've ever run a marathon, you're totally fine with participating in 2 separate races. There's one race, which is for Kenyans, and that happens at the front. There's another race for weekend warriors, and that race happens at the back, and everybody's in the same race. But the race organizers realize one thing, which is the guys in the back are never going to beat the Kenyans. And even though we're all in the same race, we're in it for different reasons. The Kenyans are in it to win prize money and fame and glory, and the people in the back are in it because it was a good incentive for them to exercise. They're going to feel really good about bragging to their friends. They're going to have accomplished a goal. I don't know what people's... You'd have to be crazy, unless you're being chased, to run that car. People have all kinds of skewed utility functions. It's different than the Kenyans. And the stock market is exactly the same. The people who are investing, the hedge fund people, the high-speed traders, they're in the same market as me and you, but we're in it for different reasons. They're in it to trade in the short run based on price changes, based on changes in information. They're information traders. And we tolerate them earning big profits because we think they incentivize the creation of information in the first place, because their trading creates liquidity. All kinds of stories you could tell. And I don't know whether they're all right or not, and I don't know whether the amount of investment in society we make in those things is socially optimal or not. No idea. But that's what they're doing. That's totally different than when I give TIAA crap $1,500 a month to invest in my 401k. I'm never going to look at it. My statements that I get that the government requires they send to me go right into the garbage can, and I teach securities law. And when I turn 75, God willing, I will open up my account and say, okay, honey, we're living in, France or El Salvador. That's where we'll be. So what do I propose? I propose we allow companies to sell their corporate information. To create a market. Companies would come to the market, and instead of having to disclose corporate information for free, they would say, imagine, we have some corporate news. We will disclose it at noon to those people willing to pay for it. You pay us, I don't know, could be a subscription like Thomson Reuters did. It could be a bespoke contract, depending on the value of the information. They would set the market price based on what they thought the information was valuable or not. And they would sell that information. People who paid the subscription price would get access to the information and could trade on it. And people who didn't subscribe, and depending on whether you're paternalistic or not, we could treat them, we could say, you're not allowed to trade. That would be paternalistic. You don't have the information, you shouldn't trade. Or we could say, you know what, go ahead and trade if you want to, but there's a big sign up here that says, adult swim. Right? If you're not an adult, you're not a high-speed trader, get out of the pool, because you're going to get kicked in the face or whatever, right? You're swimming with sharks, so if you're not wearing a chainmail suit, get out of the pool. This transparency, which is just caveat emptor, would actually help non-informed traders, because they could know there was a period of acute informational asymmetry coming. And I could withdraw from the market. I have an order in place to buy or sell securities, but now I know at noon, from noon until noon and 15 milliseconds, I'm going to get taken to the cleaners, and so I can withdraw from the market. So instead of trying to remedy informational asymmetries, which is the SEC's stated purpose, but they can't. Instead of remedying them, we make them transparent and announce them. Danger, avoid this. So I withdraw for 15 milliseconds, the price adjusts, and now I can trade at the new level. And even if I thought, oh, there's profit-making opportunities there that you would never have gotten them anyway. You were hopelessly outmatched. It would be non-discriminatory. It's a good thing. We can all be in favor of non-discrimination. Anybody can buy. You want to pay $6,000 to get access to information? That's fine. We could imagine a world in which we regulated investors and said, unless you're really sophisticated, really rich, we won't let you buy because it's bad for you. But I'm much less paternalistic than that. You want to be stupid, that's fine. It'd be transparent. Companies would announce to the market, in just the way they do now, that they had something for sale, so anybody who wanted to buy could get in. And there would be this prose-only period, the pop. It could last a few seconds. For some people, for some types of information, maybe it lasts longer. Maybe it's an hour. Very complicated information that can't be reduced to machine-readable terms could last longer than that. The price, the form of delivery, the content of the information would all be set by market forces. If investors want information more often, firms can meet that demand for corporate information by charging them for it. The form of delivery, companies that deliver better forms, machine readable, simpler, better tables, things that help investors, they will be able to charge more for their products. Just like companies that provide us with everything else, cars and toothpaste and granola bars, the ones that do it better can charge more, and they survive in the markets and thrive. The ones that don't go out of business. That kind of learning would make this disclosure radically different. Okay, benefits. Average investors will have better outcomes. They have lower trading costs. Their trading costs will be lower because the intermediaries that we trade through. When I invest in stocks today, I buy an index, I don't invest directly. I invest through someone who makes a market in that particular security. That is, someone who stands willing to buy and sell at any time from anybody. Those people charge prices for their services, the market-making services, based on their estimate of the informational asymmetries in the market. After all, those people, if there are acute informational asymmetries and they're buying or selling from anybody at any time, if they're trading against a better informed counterparty, they will lose. They pay $10, the better informed counterparty knows it's worth $5, they will lose $5 for holding that security for any period of time. So what do you do if you're a market maker in an area where there's very high informational asymmetries? You charge people more for your services. You charge inventory risk for your securities to your customers. And in a world where informational asymmetries are transparent, market makers will know that outside of those periods, they face lower informational asymmetries, and inside very high ones, that enables them to sort and offer the people trading outside of those periods, outside of the pop, lower transactions costs. Plus, I'm not going to get fleeced. The stupid noise traders, Billy Bob, who's watching CNBC, he's not going to be fleeced because now he knows the government has told him this is unfair. Don't even try. Information traders, the people who actually read the information. No one reads this, except a very small group of people who would not have the government design it this way if it was designed just for them. In fact, there's a company called Ravenpack, there are many companies like this, who specialize in taking this information, turning it into a form that investors actually use, and then charging them for it. That is per se evidence that this is inefficient. So corporations are forced to give away their information to Ravenpack, who then turns it into stuff that people want and charges them for it. What kind of rational system is that? Makes no sense. The people who use information are the people we should ask. It's like, imagine that we had disclosures from drug companies that were directed only to doctors. And yet, we required those disclosures to be written in plain English, like the SEC requires securities disclosures to be written. Why do we write them in plain English? My wife's a doctor. They speak a completely different language. Write it in their language. Write it in the expert language, not in plain English. Plain English people shouldn't be reading corporate disclosures. Liz Warren loves this one. Information traders pay for disclosure as opposed to average shareholders. Charge the Wall Street fat cats for the information they use to make profits. Why not? Why should average shareholders pay? After all, as I said, both types of shareholders, information traders and long-term shareholders, both benefit from capital allocation efficiencies and corporate governance benefits of disclosure, but only information traders benefit from short-term changes in information. My favorite part. Information traders become plaintiffs in securities fraud cases. Right now, If there's some misstatement or omission in this document, who's the plaintiff? Well, the plaintiff of record is some average Joe who has 5 shares of stock. But the real plaintiff in interest is some lawyer who is purporting to represent the class of all shareholders who have been defrauded by this line, which turns out to have been a half-truth. And to get at this, to enable this kind of lawsuit, the Supreme Court invented, of whole cloth, something called the fraud in the market theory, in a case called Basic versus Levinson. And Basic says, you as an investor don't need to show you relied on this misstatement. After all, how could you? So we're going to presume you relied based on the efficiency of the market. Sounds very Chicago. Unfortunately, that means the only securities fraud lawsuits that get brought are ones where the stocks are traded in efficient markets. Big, publicly traded firms, traded on the New York Stock Exchange. Those are the ones where the plaintiff's lawyers have the least problem getting over the Basic versus Levinson issue. But those are also the companies that are least likely to commit corporate fraud. Not that they don't ever. But compared to small companies traded in illiquid markets, like the pink sheets, they're way less likely to be engaging in securities fraud. And yet, no one sues the pink sheet companies because you can't bring class actions against them. And by the way, they don't have a lot of money, even if you did. So the whole idea of this fiction of Basic versus Levinson designed to generate securities lawsuits biases the suits against the people who are least likely to commit fraud. What happens when you charge people for information? Now, all of a sudden, your plaintiffs in securities fraud suits are identified. Who are the people who relied on the information? They are, because they paid for the information. And the fact that they paid for the information and bought it in the market is definitive evidence that to them it was material information and they relied on it. Now we have professional investors who actually paid for information and relied on it as our plaintiffs, who are likely to get much better securities fraud suits. Just so we're clear that this isn't ideologically motivated or motivated by seeing fewer securities fraud suits, because I have no idea what the optimal number of securities fraud suits is. I know those 4,000 suits were not targeted at the right group of 4,000 companies. Maybe there's 6,000 suits, or maybe there's 1,000 suits, but I have no confidence that those 4,000 are optimal. But just to tell you this isn't ideologically motivated, something else that this information traders as plaintiffs would do is open up a whole new class of securities fraud suits that currently are forbidden. If a company lies and says things are really, really bad, and you hear that lie, and you don't trade, you don't buy, because they told you things are bad. And then it turns out they were lying and things were really good. The stock price jumps up. You cannot sue. You can't sue because you didn't buy or sell. In the absence of a link to buying or selling, the potential pool of plaintiffs in that suit is the population of Earth. Because everybody could say, oh yeah, I heard that information and didn't buy. That means, given that just practical impracticability, that those suits are out. And so one whole class of securities fraud suits is something that can't be brought. Once we have people paying for information, those suits are possible. I paid $6,000 for your news that things were really bad. I relied on that and didn't trade. The class of plaintiffs is narrowed and limited, and so those suits are possible. Okay. I want to leave some time for questions, so I'll just say objections very fast. Will people provide early access? I think the answer is yes. I've provided some examples of that in the Michigan survey, the Raven Pack. In the pre-regulation FD world, companies did offer early access, but they did so in a very inefficient way. They couldn't charge for it. So what they did is they just did kind of quid pro quo favors. I'll give you the information early, Miss Analyst, and you give me some favor in return, like giving me a better recommendation that is otherwise justified. Or I'll give you the information and you do me some favor by giving me shares in some other company. So it was a very inefficient market that didn't have the benefits that I've described. Will investors pay? Well, one argument is that you will never go bankrupt by underestimating the hubris of people on Wall Street and thinking they're better than their competitors. So even though this would transparently make information equal access among high-speed traders, I think they would probably still pay. They would probably still pay because they would think, we're smarter, we can process this information better, or we can do it faster, or whatever. And again, the Michigan survey suggests this is true. Information I buy about company A, I could use to sell or buy company B, so that would be a value. And moreover, imagine that the price, the clearing price of corporate information in my hypothesized market was 0. Imagine that GE has big corporate news. They come to the market and they say, we're willing to sell this early, and everybody says, no, no, we'd rather wait till you publicly disclose this. If that's true, that smart money won't pay to battle with other smart money, that suggests that our entire security system is premised on fleecing Billy Bob from Des Moines. That is the only reason that people wouldn't pay is if they didn't think they'd make a profit. And maybe the only reason they wouldn't make a profit is because the people on the other side would be as well informed as they are. That would, as I say, be a test of the kind of dumb money hypothesis. That really what the SEC is doing when it says we're creating a fair market isn't creating a fair market. It's attracting dumb money, noise traders, Billy Bob from Des Moines to come, because that money is profit-making opportunity for the high-speed traders who are providing some valuable social service. Okay. My last one. Will confidence in the market be reduced? This is the what I call the great lie. The SEC premises almost all of its regulations on this assumption that if we tell people that Wall Street is not fair, that people withdraw their money. And again, I go back to the marathon example. That's like saying, if we tell people that the Kenyans are going to win, then no one's going to run the marathon. And I think this is just a lie. I don't think the American public is going to withdraw their retirement savings from the stock market because they think that in the short run there are people who are going to be making money trading on information that they're not going to have access to. So I think we should tell the truth, people. Don't invest in the short-term information game in Wall Street. Dismantle the regulatory apparatus that's designed to encourage you to do that. And instead, segregate the market and say Wall Street is populated by two types of creatures. Weekend warriors and Kenyans. And they're running in two separate races. Okay, I'll take your questions. Please.
So I want to go back to the insider trading point that you made.
Yes.
A lot of the misappropriation theory, if I understand it, comes along with the idea that there's something horrifically evil about disclosing information or using information that other people categorically don't have access to. Could you explain a little bit better how this kind of thing would do better than you'll go to prison forever at stopping people from trading on information that other people technically don't have access to, or as a favor of their friend or their relative, or as a quid pro quo?
Good. So I should say, to be transparent, that my prior is that we shouldn't ban insider trading, and that these people rotting in jail now are a great stain on the justice system. But let's assume that we don't want insiders trading on inside information. And again, I think it's a very questionable assumption because, well, I could go into that, but I won't. But let's just say that, let's assume for a second we want insider trading to be banned. The current system relies on the government identifying when corporate insiders are using corporate information for their own purposes as opposed to corporate purposes. Yeah, so the CEO has information, the stock price is going to fall, she sells the shares in advance of the release of that corporate information and makes a profit, okay? And let's assume we call that bad. Again, I think that's good, but let's assume we call that bad. We rely on the government finding traces of that behavior, bringing a case, proving she knew the information went before it was disclosed, sending her to jail. What would it look like in a world where the company got to sell that information? Again, the company knows, just like she knows, that there's bad news coming, day one. Day two, the company's going to sell that information to the market, okay? If it knows, the company knows, that the insider's going to trade on that information, what's going to happen to the value of the information the company's going to go and charge people for on day two? It's going to go down. Because people who know that companies companies are not policing insider trading will pay less for corporate information because the corporate information will already be baked into the stock price by the people trading on inside information. So I can imagine a market in which traders, my hypothetical buyers in this information market, make judgments about companies' ability to police insider trading, and then say, for companies who are really good at policing insider trading, I know the information they're giving me is not already in the stock price, I'll pay more for that. That gives companies some incentive, maybe not perfect incentives, it gives them some incentive to do their own policing of insider trading. Right now, they have basically no reasons, because companies can't charge people for the information that their corporate executives are tipping to friends or charging on their own. So it just motivates corporations to protect their corporate information because they can sell it. And obviously the stuff you can sell, you're going to protect better than the stuff that you've got to give away for free. That's a simple idea. Yeah.
So I take it that your proposal would apply to both large trading venues like NASDAQ as well as these off-market exchanges that you mentioned, the smaller sites that maybe aren't covered under the basic 11% presumption. So if the problem is that information asymmetries and the sale and resale of securities, how do dark pools and other alternate trading venues that deliberately mask information fit in with your proposal?
Okay, so it's a good question. It's complicated. So there are markets in which average investors are trading simultaneously with professionals. That is, I go onto my E-Trade account and I execute a buy order for the S&P 500 index. That trade comes electronically to the exchange or some market maker at the same time as trades from highly informed people, people who were paying, say, for the Thomson Reuters Michigan information early. Yeah. A dark pool is nothing just other than a private securities market in which there are no average investors. Nobody like me is trading in the dark pool, right? It is big institutional players who are trading with each other, and they choose to be dark for a variety of reasons. They don't want to leave traces in the market and whatever, okay? This problem that I've described about fairness of disclosure or whatever, none of that applies in that market because we don't have this pooling of different types of investors. So I could imagine a world in which the information is disclosed by a company and then people are trading in the dark pools and in the public pools and wherever they're trading, it doesn't matter. But the bite of the benefits of this really inure to the public markets, that is the caveat emptor parts of this. The timing and not forcing companies to give away disclosure, whatever, that obviously applies in both markets. But the securities fraud elements of it and the perverse fairness parts are really for public markets where you have average people trading. Yeah.
If I'm a professional investor, before I get the information, how could I decide whether I should buy the information from the company, and how could I decide the price is reasonable or not?
When you go on to Zappos, do you use Zappos? No. Amazon. Do you go to Amazon? Yes? You buy stuff on Amazon? How do you know whether you should buy that pashmina and whether the price is reasonable? The answer is, this isn't class, so I'm not going to make you answer. The answer is this magical, mystical thing that Adam Smith called the invisible man. I don't know. I go to the grocery store and I pick up a gallon of milk. How do I know it's not poisoned? And how do I know that $3.29 is the right price? It's called a market. So when first people go to this market, the first company who does this, ExxonMobil, has a piece of corporate information and they got to go first. And they're like, boy, how much should we charge? I have no idea. How much do you think we could charge? And they could estimate it. They could have some economists in ExxonMobil do some estimates, and they put on a price and they say, $1 billion. And then nobody buys the information. They're like, oh, okay, that was too high. And then there's trial and error. And there's experimentation. And the people that get it right, you can charge more. The people who don't. And then we learn, and then we develop, and then magically the prices reflect what the market thinks the thing is worth. And how can I trust that ExxonMobil is going to give me something of value? How do you trust that the pashmina that you bought from Amazon? Markets, they have feedback effects, they have discipline, there'll be anti-fraud rules. If ExxonMobil tells you that they're going to give you some piece of corporate information about earnings, and they charge you a bunch of money, and then they don't, you have a nice securities fraud suit. So this market would be no different than any other market. Yeah.
I have a comment and a question. The comment is that by general experience, I would conjecture that many, if not most companies, would decline to sell the information. That they would actually just conclude that they're not in the business of doing that, and so they would give it away. They would prefer to give it away. So the comment is mostly just to sort of take that into account while you rebuild the world's securities regulatory regime. You don't want to hinge upon the idea that there's a contractual relationship between two parties when many of these folks, I actually think, would just decline to get into that business. So it wouldn't be lucrative enough. The question is when William Roberts, because that's how it's going to show up in the caption, William Roberts from the one, remember him? When he cannot help himself. This is going to happen within a second or two, of the new regulatory regime coming out. He's not going to help himself. So he continues to get fleeced by behaving exactly like he did before, right? In spite of the fact that he attended all of the lectures, all this sort of thing. How are we going to prevent ourselves from trying to save the bacon by, reinventing the old regulatory system? So is there any way to kind of, to actually tolerate the various kinds of collateral damage that will continue to occur in all this?
Okay, great. So this is Dan Carell, class of '97, for those of you who don't know, and one of our illustrious graduates. Okay, so good. So with respect to the comment, will people supply this? That was this first one. I think the answer is yes, but I could be wrong. I could be wrong in the sense that companies will be very risk averse. And I expect the first companies that move, so I imagine there's some distribution of companies about their risk tolerances with respect to disclosure. And I would bet there are some companies out there who would move first and say, we'd be willing to pay for it. We'd be willing to charge for this. After all, Thomson Reuters did it with respect to information that wasn't their own. Once the SEC would say, this is fine, you could do this. I would suspect we would see some companies try and experiment, some would resist. And if the experiment was a good one, I think we would see more and more over time, but that could be wrong. If they gave it away, we're not in the business of packaging disclosures. Fine. Sell it to Ravenpack. Not a company in the world who currently gives away this information for free to Ravenpack to repackage and sell to traders. If you said to them, look, I'm going to change that deal, you don't have to repackage anything. Have your investor relations people just do what they do. Now, instead of giving it to the SEC, go give it to Ravenpack and charge them $5 million for it. I think every company in America would do that. And then Ravenpack would be the only buyer. They would just resell at some auction. They could, of course, Ravenpack could, once it got the information, trade on it. But of course, if the market knows in a transparent way that, there's only one buyer of the information, no one will trade against them. So Ravenpack would then have incentives to get in the hands of multiple buyers to create a market. With respect to William Robert, I don't view, unlike most of my colleagues, in the academy writ large, I don't view the legal project as trying to prevent every idiot from being stupid with their own money or their own behavior. However, if you believe that is the role of law and government, there is a very simple solution, which is just banning individual investors, defined in some way, from trading during the pop. So just like we keep kids out of the Adult Swim, we just put up a fence and we say, unless you've met a certain criteria, you're an accredited investor, you've answered these 10 questions on this survey in the right way, you've signed up with the SEC, you have $3 million assets under management, you can't trade during the pop. No swimming with the adults. And the cost to you would be that you would not have liquidity during those 15 milliseconds, a trivial cost. The benefit to you would be you wouldn't be fleeced, and during the periods that aren't the 15 milliseconds, your trading costs will be reduced because the people you're trading with, the market makers, know there'll be lower informational asymmetries in those periods. Okay, one more question. Yeah.
Do you think there should still be public disclosures, and if so, what would they look like if they're not being packaged to be sold for investors, and who would manage them and what?
Great. So when I'm pitching this idea with my co-author, I'm like, look, we could just keep the current public disclosure regime. That is, ExxonMobil goes and says, we'll charge you for 2 seconds early, and then we'll disclose it at 9 o'clock. Yeah. Chris, you don't need that. You could dismantle the entire public disclosure system qua investors. Because the investors who want the information paid for it 2 seconds ago. And every other investor doesn't need it. And we don't want them to get it. Qua investors. Yes? So dismantle all of it. The stuff that's in here, like that Ted Elliott went to the University of Chicago Law School and is 46 years old, and blah, 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 blah. Insofar as this is valuable for people that are not investors, that's fine. Go to the Congress, convince them to pass a statute that requires companies of a certain size or whatever to disclose conflict minerals and whether they believe in astrology or Elvis is alive. All the things that politicians think that are important about the world. Fine, I'm okay with forcing companies to disclose stuff. But as investors and as shareholders, there's no need for public disclosure. The people who pay will be highly motivated to make sure they're not defrauded when they're paid. The information, I don't need to know that GE's earnings per share were blah, 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 blah. It is utterly, it's like knowing, you know, where Kim Kardashian went to dinner last night. It is completely irrelevant to my life as an investor. So don't tell me, because it's one thing if I'm not paying and you're telling me a bunch of stuff that I don't want. But as a shareholder of American corporations, as a citizen, as someone who works in a corp, I pay. So don't tell me stuff. Don't charge corporations for things that I don't want or need. Yeah. I think we have time for one more. If anybody's, yeah, please.
Yes. My question is, isn't the market in some way already doing this? So this last week's a great example. We've seen Valiant put out tons of free information in the market because effectively their investors have demanded it. That's a system that seems to be, right, like working. They're not giving it any easier. And it's clearly not high. I don't think it's high-frequency traders that are clamoring for this information from Valiant. It's longer-term institutional investors that want to know. It looks like the information results in the past have been completely wrong. Tell us more. How does that jive with?
Yeah. Okay. Good. So great question. First, to reiterate a point I made, there are different types of information that companies disclose. Some of it is things that high-speed traders can trade on, like machine readable, the consumer sentiment is this or that, or our earnings were this or that. Some of it will be narrative. Some of it will be that it will take longer to process. It will require humans to think about and make assessments and long-term judgments. That type of information could exist in a separate market. So we can imagine companies with many markets say, okay, here's a bunch of information about our pending litigation. We're going to sell that an hour early to analysts. They're going to have it for an hour before anybody else has it. And we're going to charge X for that. And we're going to give other people information, different kinds of information, we're going to give you 2 seconds. So I'm completely open to be there in many types of markets. With respect to the production of information now, my claim isn't that the system is completely broken. My claim isn't that there aren't companies that are sort of working around this or providing some of this benefit already. It's just, imagine what the world would look like if information were produced, disciplined in a market. And the price paid would be people who are actually using the information. So I don't know who's consuming the valued information, but I want the people who consume to pay. This is just a classic kind of Pigouvian tax. We want the people who benefit to pay, not the people who are kind of operating in the background. And I don't know, I'm agnostic enough with respect to the questions about what is the optimal form, what is the optimal timing, what's the optimal content of disclosure. How could a law professor know these things? My only claim is the best way to get answers to those questions is to actually ask the people who use that, as opposed to trying to design a fair system that is aimed at William Robert. Okay, thank you all for coming, and have a great day.